Earnings quality analysis. Earnings quality analysis is a fundamental analysis technique used to assess the reliability and sustainability of a company's reported earnings. The goal of this analysis is to identify companies with high-quality earnings, which are more likely to be sustained over the long term. Overall, earnings quality analysis can provide valuable insights into the sustainability and reliability of a company's earnings. By identifying companies with high-quality earnings, investors can make more informed decisions about which stocks to invest in. When analyzing the stock market, some key metrics to consider include price-to-earnings, P/E ratios, dividend yields, and earnings per share (EPS). P/E ratios can help investors assess whether a stock is overvalued or undervalued relative to its earnings, while dividend yields and EPS can provide insights into a company's financial health and potential for growth. Inflation and sector performance. Inflation refers to the rate at which prices for goods and services are increasing over time. Inflation can have a significant impact on the stock market, as it can affect consumer spending, interest rates, and business profitability. When inflation is high, consumers may be less likely to spend money on discretionary items, which can hurt businesses that rely on consumer spending. Additionally, high inflation can lead to higher interest rates, which can make borrowing more expensive for businesses and reduce profitability. In terms of sector performance, some sectors tend to perform well in times of high inflation, while others tend to underperform. For example, sectors such as healthcare, utilities, and consumer staples tend to be less sensitive to inflation, as these are industries that people need regardless of economic conditions. Conversely, industries such as consumer discretionary, technology, and industrials may be more sensitive to inflation, as consumers may be less likely to spend money on discretionary items during times of high inflation. Geopolitical tensions and stock market risk. Geopolitical tensions can have a significant impact on the stock market, as they can disrupt global trade, increase the risk of conflict, and create uncertainty for investors. For example, trade disputes between countries can lead to tariffs and other barriers to trade, which can hurt businesses that rely on international markets. Additionally, geopolitical tensions can increase the risk of war or other forms of conflict, which can lead to market volatility and declines in stock prices. When assessing the risks associated with geopolitical tensions, investors should consider a variety of factors, such as the likelihood of conflict, the potential economic impacts of a conflict, and the potential for diplomatic solutions to resolve tensions. Investors should also consider the specific industries and companies that may be most affected by geopolitical risks, and diversify their portfolios accordingly to minimize risk. Interest rates and the stock market. Changes in interest rates can have a significant impact on the stock market, as they can affect borrowing costs, consumer spending, and business profitability. When interest rates are low, borrowing is cheaper for businesses and consumers, which can lead to increased spending and investment. Additionally, low interest rates can make stocks more attractive relative to other investment options, which can drive up stock prices. Conversely, when interest rates are high, borrowing costs increase, which can lead to decreased spending and investment. This can hurt businesses that rely on borrowing to fund operations and investments. Additionally, higher interest rates can make stocks less attractive relative to other investment options, such as bonds, which can lead to lower stock prices. The Federal Reserve plays a key role in setting interest rates in the United States through its control of the federal funds rate. The federal funds rate is the interest rate at which banks lend to each other overnight, and changes to this rate can have a ripple effect throughout the economy. When the Federal Reserve lowers the federal funds rate, this can stimulate economic growth by making borrowing cheaper and increasing consumer spending. Conversely, when the Federal Reserve raises the federal funds rate, this can slow economic growth by making borrowing more expensive and reducing consumer spending. Investors should pay close attention to changes in interest rates and the Federal Reserve's policies, as these can have a significant impact on the stock market. Additionally, investors should consider the specific industries and companies that may be most affected by changes in interest rates, and adjust their portfolios accordingly to minimize risk. In summary, analyzing economic indicators, understanding the impact of inflation and geopolitical tensions, and paying attention to changes in interest rates are all key factors in successful stock market investing. By staying informed about these issues and diversifying their portfolios, investors can make informed decisions and minimize risk. Valuation metrics. Valuation metrics are tools that investors use to assess the value of a stock and determine whether it is overvalued or undervalued. Some common valuation metrics include price to earnings, P/E ratio, price to sales, P/S ratio, price to book, P/B ratio, and enterprise value to EBITDA, EV/EBITDA ratio. The P/E ratio compares a company's stock price to its earnings per share, and can be used to assess whether a stock is overvalued or undervalued relative to its earnings. A high P/E ratio may indicate that a stock is overvalued, while a low P/E ratio may indicate that a stock is undervalued. The P/S ratio compares a company's stock price to its revenue per share, and can be used to assess a company's value relative to its revenue. The P/E ratio compares a company's stock price to its book value per share, and can be used to assess a company's value relative to its assets. The EV/EBITDA ratio compares a company's enterprise value, market capitalization plus debt minus cash, to its earnings before interest, taxes, depreciation, and amortization, and can be used to assess a company's value relative to its earnings and debt. Investors should consider a variety of valuation metrics when analyzing stocks, as different metrics can provide different insights into a company's value. Additionally, investors should consider the specific industry and market conditions when assessing a stock's valuation, as valuation metrics can vary widely across different industries and market conditions. Financial statement analysis. Financial statement analysis involves examining a company's financial statements, such as its balance sheet, income statement, and cash flow statement, to assess its financial health and performance. This analysis can provide insights into a company's revenue growth, profitability, liquidity, and solvency. Some key metrics to consider when analyzing financial statements include revenue growth, gross profit margin, operating profit margin, net profit margin, return on equity, ROE, return on assets, ROA, and debt to equity ratio. Revenue growth can provide insights into a company's ability to generate revenue and grow its business. Gross profit margin, operating profit margin, and net profit margin can provide insights into a company's profitability and efficiency. ROE and ROA can provide insights into a company's ability to generate returns for its shareholders and efficiently use its assets. The debt to equity ratio can provide insights into a company's leverage and solvency. Investors should consider a variety of financial statement metrics when analyzing stocks, as different metrics can provide different insights into a company's financial health and performance. Additionally, investors should consider the specific industry and market conditions when assessing a company's financial statements, as financial statement metrics can vary widely across different industries and market conditions. Industry and competitive analysis. Industry and competitive analysis involves examining a company's industry and competitors to assess its competitive position and potential for growth. This analysis can provide insights into the broader trends and conditions that are affecting a company's industry, as well as the specific strengths and weaknesses of its competitors. Some key factors to consider when conducting industry and competitive analysis include market share, competitive positioning, barriers to entry, industry growth potential, and regulatory environment. Market share can provide insights into a company's competitive position within its industry. Competitive positioning can provide insights into a company's strengths and weaknesses relative to its competitors. Barriers to entry can provide insights into the potential for new competitors to enter a market. Industry growth potential can provide insights into the potential for a company's industry to grow in the future. The regulatory environment can provide insights into the potential risks and opportunities associated with changes in regulations and laws. Investors should consider a variety of factors when analyzing a company's industry and competitors, as different factors can provide different insights into a company's competitive position and potential for growth. Additionally, investors should consider the specific industry and market conditions when conducting industry and competitive analysis, as industry and competitive factors can vary widely across different industries and market conditions. By conducting a thorough analysis of a company's industry and competitors, Investors can gain a better understanding of the broader trends and conditions that are affecting the company, as well as the specific strengths and weaknesses of its competitors. This analysis can help investors identify potential investment opportunities and risks, and make informed decisions about whether to invest in a particular stock. In summary, advanced fundamental analysis concepts can provide investors with a deeper understanding of the factors that affect a company's performance and valuation. By analyzing economic indicators, understanding the impact of inflation and geopolitical tensions, paying attention to changes in interest rates, considering valuation metrics, analyzing financial statements, and conducting industry and competitive analysis, investors can make informed decisions and minimize risk. However, it is important to remember that no analysis can provide a guarantee of future performance, and that investing always involves a degree of risk. Therefore, it is important for investors to conduct their own research and analysis, and to consult with a financial advisor before making any investment decisions.